Hey, Joe Mastriano. Welcome to Live in Five. And today, the topic is how you will lose your IRS audit. So, since 1980, when I started my CPA firm, I was only 25. I've done thousands of cases and I've represented, I don't even know how many people in audits. And auditors used to be attorneys, CPAs, at least people with accounting degrees. But now people with uh, gender type degrees, anything, you can be an IRS auditor. And so when we discuss audits with IRS auditors, also called revenue agents, uh, collection offices are the people that go after you for money that you owe. So these revenue agents just follow their manuals. They're not versed in accounting and tax principles at any particular level beyond the training that they get from the IRS. Should be a 1 year training, but I question the level of training they've been getting too. Keep in mind, I've been doing this since 1980, which is more than 40 years. So, what we now have is these revenue agents browbeating people. I've seen cases, and I can give you one that I currently have right now. And that's a case where I have a client who set up a trip for her and several of her friends, and they never booked the trip because they changed their mind. And she has evidence where she got the money, gave the money back, and now has third party notarized statements from each person that they gave the money, and these are the amounts and the dates and when they got the money back. But that's not good enough. So we're going to see where to go from here. And these are things that never have I experienced before in decades because um, how much more detail, how much more evidence can you give that the money you got and gave back was not income? So I'm going to continue to urge people to make sure that they properly have their returns audit proofed, which means if you're going to these national tax preparation companies and not going to a professionally licensed company because you're trying to save a couple of $100 or something like that, I think you're crazy. I have a 4-part checklist, and those of you who listen to my video at the end before I sign off, I usually give starting now. This will be the first one of those 4 items. These items are not included in what you read in a paper or now on an online blog that says the 10 red flags that can cause an audit. Sure, you should read that. There are basic things about including your income and making sure things total up properly and that you use the right forms. But there's other factors that carry more weight than that. Now, once your return is audit proofed, well, you also need to make sure that you have a good understanding of each item on the return. No more totally trusting a tax preparer and what they tell you. If the preparer says, oh, all you need is your receipts and cancel checks, then everything's fine. Go to a different preparer because the burden of proof is on the taxpayer to show the nature of the transaction and that the rules were followed. When people ask me if something's deductible, for example, I tell them that each item has its own set of rules. Yeah, there's the basic general rules that have to do with receipts and cancel checks and invoices from the company. A lot of people still don't realize what qualifies as an invoice. But the burden of proof, although kind of tacit sometimes, you're not asked directly, is to prove to the auditor that these were kind of ordinary and necessary expenses. Sometimes they can be extraordinary, but you have an additional burden of proof. Or prove to the auditor that, under the circumstances, it was prudent to incur these particular expenses. Very, very important. There's several cases, several well-known cases. I could think of Nicolas Cage, famous actor, who spent a couple of million in a party during the time that his movies weren't doing very well, and his attorneys didn't seem to give the right explanation. They just assumed that, you know, given the past and that he's famous, he could spend as much as he wants inviting directors and cast members and other people to these big parties. But they're not justifiable if you're not making income. The way the IRS looks at expenses is you've got to look at a direct relationship, sometimes indirect, but again, each thing carries its own burden of proof. There was no direct relationship that he was making money that they can tax based on the necessity of having that level of an expense. Perhaps the party should have cost one third of the amount that he spent. I don't know the particular numbers or what they allowed, but to me, that's always been a good example, um, because on the surface, something can appear to be justified, and someone can say, "Well, I have a business, and in order to carry on the business, I have to take these people to lunch, and I'm a manufacturer's rep, and the people that buy for the companies usually buy from the reps that spend the most money on them." And there's a lot of older practices now that have to be looked at again too. So I have this 4-part checklist. I'm going to give you one now. I'm going to sign off. Nobody's asking any questions. And one very critical item, and again, you've got to be a fool to send in a tax return um, without making sure you and your preparer knows what the IRS has on you first. It's called the wage and income transcript. I can pull transcripts for people. In fact, we have a $500 special where we'll get a power of attorney on file, pull the transcript, and explain it to you. Normally, that process takes a few hours. At 195 an hour, it could run up 600-700 or so. We'll do it, for five, just so. And that's me personally doing it, by the way. Um, and that's so I know usually people are surprised at what's on their transcripts. It's almost never fails. Returns get lost, payments go to different places, additional audits of years that people aren't even aware of that those years were audited get put on transcripts, and then their money is put to pay that, and so the current year is delinquent, and they're screaming, "I paid all my taxes. How could I owe 20,000 on that year?" Well, if you pull the transcripts, then you'll see what was reported to the IRS. And if you list them individually on the return, then they can line them up item by item. A big, big mistake that a lot of companies, I don't care if they're law firms or CPA firms, a lot of them hand stuff down to juniors, and they'll take 1099s, total it up, and put it on a Schedule C for self-employment individual. And the IRS has no idea whether you included the 1099s or not because they're totaled up and mixed with income that's not on 1099s. What our practice is we list each one separately, and then what income is not on any 1099 so they can total it up and match it. Failing that matching, I wanted to call it principle, but failing that matching process causes a lot of audits. So I'm going to end here. And as always, um, You can call Stephanie, 713-774-4467. Set up a consultation, and I could make you such an expert on understanding the basics of what everybody should know about dealing with the IRS and doing your tax returns. That's it for today. See you next time.